Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Okay, good. I say it every Wednesday recently, but not more than 5 minutes on Exhibits A, B, and C, or RAN, or whatever we call it. I don't believe anything has changed since the beginning of March. There are all these predictions that oil's going to go to 150 unless something's resolved. And I would say that's a consensus view when I talk to people I know in the industry. And I believe that the industries, the people who produce the oil, move it around, are capable enough to figure out ways to make up all but about 3 or 4 million barrels of the 20 million barrels that go through the Straits of Hormuz at normal times. And they're going to do that even if things ease up in the next couple of weeks, the next couple of months, because they're not going to trust Hormuz as a way to market their oils. So Saudi Arabia is taking oil out to the Red Sea. They have pipes in place. Saudi Aramco runs the oil business, owns the oil business. It's actually a publicly traded company. Said that in March, they made more cash flows and more revenue than they did February. So the Saudis are doing fine. The second largest producer amongst the Gulf Arabs is Abu Dhabi. Abu Dhabi can take half of its oil, around 4 million barrels a day, down through Oman and to Fallujah, which is a state in the United Arab Emirates, and where they have a huge terminal. And the ADNOC, Abu Dhabi National Oil Company, is ordering pipe to twin that line so they can take all the production down there. Kuwait and Iraq are landlocked, but there is a pipe from northern Iraq up through Turkey that will be heavily used by Iraq. Both Kuwait and Iraq are currently moving oil by truck through Syria. Syria, along the Mediterranean coast, has, I think, 3 ports where oil can be loaded, including one port where there's a refinery. So moving oil by trucks works in the short terms. In the longer terms, there is a pipe, maybe 2 pipes that run through Syria. They haven't been used to any great extent in recent years, so there's a fair amount of rehab work that can be done. But no matter what happens with Hormuz, those pipes will be reactivated. They'll continue to have many, many trucks transporting oil, and those Syrian ports will be improved. Now, why is all this important? If this doesn't happen, Iran has too much control over the economies of the world. It's the people who are making these decisions, the national oil companies, the service providers to those companies, many of them are U.S. companies, are, I think, doing a superb job. And in time, Iran will not be able to hold the Gulf Arabs, the world at large, hostage. One of the tricky parts is that one of the Gulf Arab states, Qatar, has some of the largest facilities in the world to make LNG. You can't transport LNG by pipe. So I think what's going to happen there is that the markets for that LNG, Pakistan, India, China, other Asian countries will make deals with the Iranians where they will charter the ships in to be run under a Chinese flag or a Pakistani flag, and Iran will allow those ships to go through after they pay a toll. I think some of that is already happening now. The U.S. wants to have Iran give up its enriched material. It's close to bomb quality. They want to have supervision over the centrifuges, which is used to enrich uranium. And I don't believe the Iranians will agree to that. So I think that the U.S. will continue to embargo all Iranian imports indefinitely. But I believe in that time frame, given these ways of getting around for lows, oil will hold, whether it be Brent or WTI, will hold at the $90 range. Now, as of last week and this week to date, Brent is like 108, WTI is 104. Those are above that $90 range that I keep predicting, but I think this is what's going to happen. The consensus in the industry, the people who do reports, write reports and whatnot, say that this can't happen, that oil will go to 150 and that inventories all over the world will run out. I don't believe that's true. On Exhibit A, nothing really to report. Great deal of publicity about the apps generated by the companies that have the language models to do. Our biggest expense, our big expenses on Exhibit A are interest. Interest rates are actually going up. So that interest rate forecast is based on 3.5% average interest rate, whether it be short-term or 10-year. I mean, the 10 years now 4.5%. Interest rates are going to be higher. That's not good for that line. Obviously, defense is a big line. And then the biggest line is Medicare, Medicaid. All these apps, and especially the Claude products from Anthropic, applied in the healthcare industry is going to make everyone much more efficient. So my fervent hope is that our expenses overall for healthcare are flat to declining a little bit, and that includes Medicare and Medicaid, and that would be just terrific. And that we will eventually be able to reduce our deficit and stabilize our ratio of debt to GMP about where it is, which is around 100%. Okay, over to you people. Just as a lead-in, we've been looking at industries, different companies' positions. We're not calling them moats. It's much more than moats. Theoretically, company can have a monopoly and have a not very good business that maybe is declining in terms of revenue and cash flow. That's not what we're talking. We're talking at positions of companies to not just hold off the competition, but to build from the position they're in. And it's the person that we get this Lilly, and we've done Nvidia, we've done Microsoft. I think we have a really good idea for this Wednesday, which is when artificial intelligence, when the chat product came out, everyone said, oh my goodness, this is going to be a real risk to the monopoly that Google has in search. And in fact, Google at that point was probably, I don't know, like Jason would be more specific, but $140, $150 stocks compared to double from that level, because it turns out that it wasn't that much of a risk to search. But I think Mike, Jason, and I think that maybe there still is a risk. So if that is an introduction, over to Mike and Jason.
It's amazing how markets tend to have amnesia, because something that is a popular narrative that gets people all spun up for one period of time is very quickly forgotten. But some of these risks are still here. And I do think the better lens to kind of take a step back to think about Google is what's happened with the antitrust cases. And if you remember, in one instance, there's still remedies to be played out on the ad tech stack. In the other instance, they were not forced to divest Chrome. And they were forced to provide some of their data to be available to would-be competitors. And I think that's that
web index data.
Web index data, yes. And I think that is not perceived as a threat because it's not an imminent, immediate threat. But it is going to create some more competition. I think the current framing around search is maybe some concern that ChatGPT will take some share away. And I think that's certainly happening some on the margins. We can talk about this in more detail about what types of search end up on ChatGPT. But I don't think that's really the big question. I think it's how will this business of search and information discovery change over the next 20 years? Because Google has dominated the last 25. So before I really get into this, Jason, don't hesitate to interrupt me. Same with you, Hunt, because I have a lot of information here. So I could probably go for a really long time. But I want to recap a couple of the things that are happening. One, Google introduced this feature called AI overviews. And this was clearly in response to the fact that people were moving their search queries over to ChatGPT. And I think this highlights maybe two things. One, that people often did search and do search Google for things that aren't easy to index against. In the early days, we all got fairly good at typing the words in a way that were easy for Google to help surface the things you were looking for. Over time, Google's got better at that. And today, you can just type in a whole sentence into Google search, and generally it'll come up with an AI overview to answer your question. This is the sort of stuff that was going to ChatGPT, where the user maybe doesn't fully understand what they're looking for. Now, Google was wise to choose the types of searches that it was going to provide these AI overviews with, because the suspicion is that they don't necessarily monetize at the same rate. And maybe those queries were never really monetizable, which is part of the rationale that one would have against a ChatGPT type search. But over time, the user's expectation for what these technologies are going to be able to do is going to move from, I want to buy a new pair of Nike shoes, to, I want my agent to go and buy the Nike shoes that it already knows that I like and ship them to my house because it knows that my old ones are probably worn out by now, or something where the user is less involved in the transaction. So I think that is the risk. If you think about the next phase, the risk is that monetizing the eyeballs for the decision-making just changes pretty significantly. The core offering that Google's providing is information, and it's monetizing it through advertising. How do you advertise to an agent? Probably don't. You probably provide a web index, if you will, for free that basically is sponsored. And you probably, I don't know, I'm spitballing at this point.
The web index isn't free. And I've often wondered how much of the additional revenue that Google search is bringing in is billing to OpenAI or web index grounding of queries that people run there.
It's certainly happening more. We do a lot of it. We use Brave for some of it. There's Exa is another interesting use case. Exa is a startup that recently raised a $225 million round at a $2+ billion valuation from A16Z to be an agentic type of search to move to this new paradigm. Now, the question is Google ripe to be disrupted? And I don't necessarily think so, but maybe Jason, you should run us through Google I/O yesterday and what your takeaway was.
First, I think they're not out of the woods, but what they've done has been really smart. That, like you were saying, that they provide an AI overview to your query for things that are just more general questions, but queries with intent, like those Nike shoes you're looking for. The first thing that's going to pop up is probably their little shopping banner, and those are all ads placed in there, and you have a really high purchase intent, and those queries probably did not move away from Google, and they're going to monetize them at the same rate they were. But so they had their I/O event. I haven't gone through everything, but there are some interesting things that came out. They announced a new language model, a new video model, just evolution of their current stuff. One really interesting thing, though, was they announced a content-credentialing system, which essentially allows you or some system to identify if an image is the original taken from a camera or if it has been processed through any kind of AI tools. So we've said for years now that this kind of thing needed to be invented. It's great that they have a solution. It'll be interesting to find out how effective or how easily defeated it is when it gets into real world use. But it's something that needs to be there. The most interesting thing to me is Gemini Spark. So this is essentially Google's OpenClaw. This is their agent, and it runs 24/7 in their cloud, and it has access to all of your data, your personal data in your suite of apps that you use within Google. And This is data they already have. You've already given Google, obviously, permission to collect all of your email, all of your calendar data, everything you put in Drive. So you're not letting a new tech company into your walled garden of your private data. Google already has it. So this agent can run on any of your data, and you can use it to, I know there's kind of silly examples, like you can have the agent invite all of your close contacts that you've corresponded with in the last 6 months to a barbecue and draft the invitation and send it all autonomously. I'm sure they're going to come up with a lot better uses than that, but that's the kind of thing it will be able to do. And the plan is to extend this outside of just Google's products by the end of the year.
If you look at page 1, just to show that half of the alphabet stock, the 52-week range on Google is a 162 low. And as of last Friday, it was around 400. When we compare that to Amazon, the 52-week low was 200, and it was 260 last Friday. Apple, just under 200, was 300. Microsoft, 422, and their 52-week low was 356. So the change in sentiment on Google, first of all, I guess Google did a terrific job. Old OpenAI or whoever else was going to challenge their primacy and advertising. Because after all, Google runs on advertising. They do have subscriptions, so maybe they can have significant subscriptions from Gemini, just like Anthropic does significant subscription income from Claude. But mostly most of their revenue is advertising. What I don't see, and Mike and I have been talking about this when we talk 20 minutes every morning, I don't see how anybody is going to compete against Google and Facebook. And I guess Amazon has some advertising. It's just going to be very difficult to get those advertisers away from those tools that they've been using. And I think OpenAI thought if they had 1 billion users, they'd be able to make money from advertising. What Facebook has, 3 billion users or something, and they do fine. But it seems to me OpenAI is compelled to go back, since Anthropic did so well with subscriptions, go back and copy Claude. Jason, is that way too simplified a view of it, or was it look from your vantage?
I don't think so. I agree. It's the barrier of entry to building an advertising network's huge. Amazon is the new one, and it's been years and years of progress. And they have most American shopping data through Amazon's storefront, but it's still slow going for them to even catch up to Meta or Google.
Yeah, there's no question that the existing business is good, but how does this change? And I think I/O was an interesting way to look at what's happening at Google. I think Google recognizes that the future will not be, the next 10 years will not be like the last 10 years.
They face the innovator's dilemma of, do they cannibalize search or not, so that they're still relevant in 10 years' time? And it's looking more and more like that they are willing to blend the chat AI interface into the search bar. They've announced a lot more integration there. You'll be able to treat it more like a chat interface.
And that's the difference. So I/O, they announced tons of products and cool stuff. And it makes me think of Bell Labs back in the day, right? They were doing all sorts of cool stuff, but they just didn't release it to anybody. At least Google is releasing it, at least in part. They're certainly being careful so that they don't completely cut off a limb, if you will. But the threat is still there. And there's going to be more competition from different angles. So now, and maybe there's a question also on demand. How many dollars will be spent in advertising in the future? Will it grow just with GDP? Will it grow ahead of GDP? Will it grow below GDP? Because I'd be shocked if it grew below GDP. But either way, there's one way to think about it is, how does digital advertising fare over the next 10 years relative to the last 10?
Right.
Yeah, I can't imagine that digital's going to lose much ground.
And certainly OpenAI has a lot of user data that they could monetize. So if they're going to take a slice of that market, it's someone's expense.
Jason, we got to switch over to healthcare. Otherwise, their adherents to our podcast who think we don't spend enough time on healthcare.
Sure. So some of the news, it's more U.S. national level news. Bill Cassidy was defeated in his primary. He was the senator that led the healthcare committee and a lot of confirmation hearings. He was a voice of reason within the Republican Party on more of the controversial, where they push the envelope kind of ideas. He was a gastroenterologist by training, so it's good to have his different viewpoint. So kind of sad to see we're going to lose that from the Senate. OptumRx had a full launch, if you will, available, but they've launched a new updated version of it. It has really a rich catalog of drugs and many generics. And despite anyone's personal feelings against the title of this thing, I encourage you to go look at it. I believe they're using cost plus drug behind the scenes. And even they said Amazon fulfillment, as well as being able to send scripts to a local pharmacy. But it really is shocking how much cheaper some drugs are available on that platform. I just did a few searches just to explore, and you can find drugs where at a quarter of the price of your copay on some things.
And what this does, big picture, is it provides competitive balance in the PBM industry.
Yes. Yeah. And I think this really is the result of all of the most favored nations agreements that were negotiated. And now we're putting forward an online marketplace to be able to purchase those drugs from the manufacturers and cut out the PBMs.
Yeah. Which is a really rational way to approach government, is like, if you can't price better than the federal government, you have no business running a for-profit operation. But I don't know. That's the way I kind of see it.
Yeah. Yeah. And there's been some adjustments from those companies. So CVS has come out in the last week and announced they're going to carry a lot of biosimilars through their pharmacy now, where they've previously not carried them. They would rather have the brand name drug at a higher markup and thus a higher overall profit, but they're going to carry a lot of biosimilars now at a much lower price point. United, through OptumRx, has announced a new transparent pricing model for their PBM and GPO, which is a big deal because it's a hide the profit game. PBMs have shifted a lot of their revenue recognition to the GPO to hide that, to say that the PBM's not taking a large cut. But for both those organizations, they're going to move to a flat fee structure, is what they've announced. I don't know if it had a timeline associated with that. And then related, but not necessarily drugs, is UnitedHealth announced that 30% of minor treatments and diagnostic processes will no longer require prior authorization. So these are all kind of big steps that has been forced on the industry, that they have to start behaving better and lowering prices. So I think a lot of this it's not just government's push. We see Eli Lilly having a ton of success with their direct-to-patient marketing and platform to deliver their weight loss drugs. And I think the pharma industry overall has a very antagonistic relationship with the PBMs. They point the finger at each other saying, who's the real driver of increased cost in the US? So the pharma industry is fighting back. They're bypassing them. And I think PBMs are realizing they've lost a lot of that pricing power now.
Hey, Jason, if you use similar strategy to what people pay in monthly premiums for health insurance, what would you do? I know this is not a rehearsed question, but I can see where they made enormous progress to try to bring the cost of pharmaceuticals down. Kudos to Trump, who's kind of led the charge here, and to the people who've worked on it. But that's only, 10 or 12% of our healthcare spending. What about the people who pay premiums every month for healthcare? What can be done to rationalize that somehow? Could you use the Trump RX or Lilly going direct? What are the kinds of things you can do and help people pay for their healthcare? And what can be done? Obviously, the premiums are going to be impacted by what the health expense is that the carrier provides. Where, if you sat down with a blank piece of paper, where would you start?
Oh, it's a harder challenge there. One big piece that is going to be extremely difficult to figure out is emergency care. You have no ability to price shop when you need emergency care. But outside of that, there's no transparency in pricing. The cost of a diagnostic or a simple procedure can vary by 10x within a single city, just depending on which clinic you go to. So first, we need to enforce. There's rules of price transparency that no one follows. We need to start enforcing that. I think maybe if there was a system where you could essentially shop your care, that could maybe help. The problem is still that insurance is the payer. You pay your premiums and you don't have an incentive to lower the cost to you.
Yeah, that's the problem. And that's why I think you need to have some sort of an account where if you can manage to underspend your account, that is compounded over time, and you're able to pass it on to your heirs or donate it to charity at the end of your life. Something to make that have some level of value.
Yeah, unless you burn through it, what happens then? Or if you have a budget you've been diagnosed with cancer, here's your budget to fight it. What happens if that doesn't do it?
When you run out? Yeah, these are the hard things.
Yeah.
My way to approach it would be to start on the other end, offer a plan that requires significantly more diagnostic monitoring. If you can opt-in plan, and with that, provide discounted premiums, or at the very least, discounted copays. And you demonstrate that by using that data, you can provide better care over the long run. And there's a number of companies that have started with that mission. It's just very difficult to implement because it's expensive. You have non-compliance issues. So you need to make it financially incentivized for people to live a healthier lifestyle.
Yeah. The system.
How about a system, Jason, in mind where you pay so much per month, but every quarter, if you incur less cost than what you're paying, you get a rebate, or you get a note saying the next quarter you pay less per month. So you give the person who's paying the premium an incentive to try to shop around for healthcare.
Yeah, I like it. And I think you tie it to diagnostic monitoring, right? If your stats look good and you're not using the healthcare system a lot, why should you be paying all of the money out?
Yeah. Every quarter you get what the next quarter's bill is going to be. So if you took care of yourself and didn't have any issues, or if you did have an issue, you shopped around, kind of like the way people are being encouraged to do with pharmaceuticals. Yeah. To Jason's point on emergency care, it seems to me that it should be possible to set up some type of insurance system where everyone contributes, and the people that don't need emergency care don't use it. But it, in effect, take emergency care and make it a separate business or a separate line of business.
Well, yeah. What is insurance for? I think that is when this all boils back, is like, how do you separate ongoing care from emergency care? Because emergency care is what we need insurance for. We all also need some level of ongoing care. And
also the person who catches cancer is, are you aware, we go on for the next couple of hours probably, but are you aware of any for-profit healthcare insurers or hospital chains or whatnot who have a more systematic, rational way? In other words, is there someone who's doing it well or promises to do it well where we should make money as investors because they just have a much more logical way to organize healthcare?
We should do an episode on this.
Yeah.
Yeah. There are a few hospitals that have completely different models. And I think they're being pretty successful. We have a friend doing this in Ohio, I believe.
Yep.
Yeah.
And there's some companies that are now public that are doing different things with health plans and diagnostics and monitoring. So there are real experiments happening today.
Yeah.
It'd probably be worth a whole episode.
Is that next Wednesday? Is that enough time, or do we need 2 weeks to get ourselves prepped to?
I think we need two. I think we need 2 weeks.
2 weeks. 2 weeks from now, in the middle 15 minutes of our podcast, we'll try to come up with 3 or 4 entities, whether they be public entities, whether they be hospitals or health insurers or whatnot, that are doing certain things that will make them good investments and also contribute to better healthcare to the people who use their service. And then in the in-between week, next week, Mike and Jason and myself will come up with a surprise. We'll have a surprise next Wednesday, and then the Wednesday following, we'll try to come up with investment opportunities for people that are doing a logical thing that will provide better healthcare at lower cost. How's that for an agenda, Mike and Jason?
I like it. Yep.
Yeah. Okay, in the meantime, everyone be well and stay healthy, and we'll be here exactly 7 days from now. Thanks, everyone, for listening. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.